I want to say a couple of words about ratios for these two companies, Tiffany's and Flowers. We've looked at some of this stuff as we went along, but now we want to summarize up some of the reasons that we use ratios. And in each of the chapters of your book, these ratios are spread out and they're tied to the individual pieces that each chapter dealt with. Let's start with gross profit. Now, when we were looking at the common size income statement for these two firms, one of the things that we can see is that the cost of goods sold as a percentage of revenue is much lower at Tiffany than over here at Flower Food, which means if we look at the gross profit margin, it's materially higher at Tiffany's than it is at Flowers, and the margin's higher. That's a reflection of the type of products they sell. If we look at the difference there is roughly 15 points, all right, 47, 48% to 62, 63%, right around 14.5% or 15% when rounding. Notice that when we get to the operating profit, Tiffany still has a higher operating profit relative to Flowers, and the net income per dollar of sales is much higher. So when they make a sale over at Tiffany, they mark that stuff up and they made a good profit on it. But if we look at the number of sales they make per dollar of assets, we can see that Tiffany's sales, which are about $4 billion, are about 67% or two-thirds of the level of assets. So they have more assets than sales. What does a company have assets for? To make sales. And a lot of those assets at Tiffany are inventory. Contrast that over here with our good friends at Flowers. They make a lot of sales with the assets they have. Okay, so that makes them more efficient. So just looking at the sales profitability doesn't always give you the full picture. And that's why financial ratio analysis and financial statement analysis is actually something of an art form. There's no good or bad numbers. You actually have to get in there and figure out what does it all mean. What it means is Tiffany's needs to have a whole pile of assets, especially inventory and leasehold improvements. Well, those are the store locations to generate their $4 billion in sales. Flowers can generate $4 billion of sales, but they don't need near as many assets to do it. If we go out here and look at the balance sheet for Flowers, if you look at the total assets, they can generate $4 billion of sales with $3 billion of assets. Tiffany needs $6.6 billion of assets to generate $4 billion in sales. Okay, different way of doing business. You'd also see that if you compared Walmart. Walmart doesn't make a very high profit when they make a sale, but they make a lot of sales. So what we see here is the Flowers model is you could sell everything for $1, but sell a lot of things. With Tiffany, you sell everything for $100, but you don't sell very often. But when you do, you make a good bit of money. We can also look at days of inventory. Days of inventory is simply if you quit replacing the inventory, how long would it take you to sell everything? Flowers, you would be slap out of flour, bread, your finished product, all the other cakes and cookies you made in 3 weeks. It would take 541 days for Tiffany to sell off all their stuff. They don't sell their stuff very often. All right, when they do, they make a good profit on it. They have to hold a lot of inventory to be able to do that. So the days of inventory or how long it takes, generally the average days that it takes to sell inventory, 540 days is a year and a half, as opposed to 3 weeks for Flowers. It isn't, neither one is good or bad. They reflect a different model. Flowers can't hold inventory. They have to remake that bread constantly. They're baking every day. With Tiffany's, they go out there and make those diamond earrings. The diamond earrings will keep. They'll stay on the shelf for a good long period of time. The inverse of the turnover, or inverse of the days of inventory is the turnover ratio, which is simply cost of goods sold divided by the inventory. And that gives you an idea how many times you sell the inventory each year. Okay, well, if it takes you a year and a half to sell all of it, then that's about 7/10 of a year to turn it over once. Did I say that right? If it takes you a year and a half to sell it off, then you can sell it 0.7 times per year because it takes more than a year to actually sell all the inventory. Whereas over here at Flowers, every 3 weeks they sell off all their stuff, then they can sell off all their stuff about 17 times in a 52-week year. Days of receivables is how long on average it takes you to get paid from accounts receivable. That's the average number, and you can see they're actually fairly simple. About 20 days, about 25 days. That's because most people that come in here and buy on time from Tiffany's, they don't have that much. They sell most of their stuff either for cash or somebody funds it some other way. Flowers sells their stuff to groceries, and they collect fairly quickly. That's because, they're delivering bread every week. If we look at how the assets are funded, with Tiffany, 100% of the assets are funded with 58% are funded with 50% debt, 50% equity. With Flowers, it's more 60% debt or other people's money, 40% equity. If we look at the mixture of the liabilities, we can see that they're about the same with the current liabilities as a percentage of assets, but Flowers has a lot more non-current liabilities. We already discussed in the earlier video that Flowers has non-current assets considerably higher than their current assets. That's because they have big plant and equipment and big old bakery ovens and delivery trucks and all that other good stuff. Tiffany's not as much. A big chunk of their assets are that inventory. And then when we go down here and look at the makeup of the equity, contributed capital, roughly 20%, retained earnings, a little over 30%. And it's similar numbers over here for Flowers, except the big difference is the other equity. They have bought back a chunk of their shares there, that's what's actually reducing their share of total equity from 50-50 to 60-40. So that'll give you some idea how we use ratios to start making comparisons. There's no such thing as good or bad ratio numbers. What they tell you is they tell you a story. They tell you where to go look. If all I did was hand you these total asset ratios and say, okay, well, why is that? You would know where to go look. Why are the assets so high, the non-current assets for Flowers? Let's go see what they got. If you were to look at some of these other things like days of inventory, and I didn't tell you this was Tiffany's and Flowers, if I just said, okay, company X has days of inventory of 541 and company Y has 21 days, well, you're immediately going to start thinking, what are they selling? I don't think they're selling soft drinks where it takes 541 days to sell off all your stuff. All right, so different types of businesses have products that can sit on the shelf a very long time, and other types of businesses have products that better get off that shelf in a very short time or they're going to spoil. All right, so ratios don't tell you good or bad, they just tell you where to go look to try and figure out what's going on with a company.